Tina Linder's in the correct position on the moon. Let me inform Member Romeo. Elio and are making fresh lows after hours.
HPE first quarter adjusted EPS 49 cents a share. This is a 50-cent estimate for Hotel Papa Echo. Revenue coming in at $7.9 billion, which was a slight beat for HPE.
Guidance range for next quarter at 7.2 to 7.6 billion versus 7.8 billion consensus for Hotel Papa Echo. Earnings guidance 28 to 34 cents, well below 47-cent estimate for Q2.
American Outdoor Brands, $58.5 million in revenue, was up on a year-over-year basis. GAAP earnings 21 cents a share, also up year-over-year.
LSCO reporting 20 cents for earnings, a 7-cent beat, revenue slight beat, Liam Oscar, Charlie Oscar. Your CEO, okay, naming a new CFO, Charlie Oscar, Oscar Kilo.
Mario, you can see everything? You're good here? We got a good 7 minutes anyway. We got time. What time we start? 4:15. I got a bad headache today. This weather. Oh, look at that. That gelled insider buying. Thank you, Mario. Papu! How are you, Papu?
Samsara IoT reporting 346 million in revenue for the quarter, being a 335 consensus. India Oscar Tango, 11 cents for earnings is a 4-cent beat.
Is Avgo one of these West Coast names that report at 6 o'clock? Pain in the asses. Today's 4:15.
Figures.
So we'll wait a couple minutes here for Avgo.
So we'll get Costco,
Oh, Costco too.
Gap, and Broadcom in a moment.
Costco too.
Costco COST, 63.7 billion in revenue. Beats a 63.2 consensus estimate.
This is not showing after hours?
Broadcom $1.60 for earnings is a 10-cent beat. Alpha Victor Golf Oscar.
There we go. Oh, almost spilled the coffee.
Broadcom revenue of $14.9 billion beats a $14.6 billion consensus.
Broadcom up, Costco down.
Costco US same-store sales up 8.3%, adjusted 8.6%.
Broadcom guidance midpoint at $14.9 billion for next quarter, above the $14.5 billion consensus. Broadcom shares up a couple points on their earnings. AMT raising quarterly dividend by about 5% to $1.70. Alpha Michael Tango.
Throw this out. All right. I think everything's out now, right? HPE, what they end up doing? Oh, what happened there? Hey.
Last minute the gap reporting.
The gap.
Fourth quarter global comp sales up 7%. That's better than expected. For Gap, 54 cents on the headline. Beats a 36-cent consensus. Old Navy same-store sales up 3%, which is better than expected. And total sales.
All right. Let me go through. We'll go through a couple things here. How's everybody doing? Hoping everybody's having a fun week. All right. All right. Yeah. So let's talk a little bit about where we're at, where we came from, and that few things to keep an eye on. What I'm keeping an eye on. A few things you guys may want to keep an eye on if you're looking to be more aggressive, less aggressive. So we'll go over a couple things there. First things first. Just to get an idea, obviously there's a lot of noise out there. You got Trump obviously being the loudest with tariffs and all, but there's more going on, right? Behind the scenes. It's not just a tariff thing. The tariff thing could be playing into the growth scare that we're seeing, but we're definitely seeing a growth scare out there. A few cracks. I wouldn't say major cracks, but some cracks in the tech theme, the AI theme. No doubt there are cracks in the growth and momentum theme. Some of the names, especially retail, has been extremely excited about some air coming out of the balloon. This is, again, I don't think it's really too important, at least for my sake anyway, to try to pinpoint what exactly is behind what's going on. I think what we saw prior to this, right? Some of the things that we were discussing, some of the things that stood out, potentially signaling that this would show up at some point. Obviously, the timing of it is always very difficult to pinpoint, but that something like this would show up, and because of it, there was a lot of risk everywhere, right? Because you don't know how things are going to react until you get there, right? You don't, again, if you're worried about tariffs and you're buying stuff that has nothing to do with tariffs, at that point in time when the market starts to sell off the catalyst of tariffs, there, could be a million other excuses. And we're seeing that now, right? You're seeing names that have nothing to do with the tariffs be affected. So anytime that overhang, right? It's basically an overhang of risk is above our heads, it makes it really difficult to get excited and put on too much longer term, intermediate term weight as far as long exposure is concerned until we get through it, right? So the good news is we're getting through it now, right? And what's interesting is we were talking about that potentially a growth scare, right? Because and it's not, crystal ball, Miss Cleo shit, as you guys like to say, right, Miss Cleo? Even though I don't even know who Miss Cleo is, but I hear you guys use the term a lot. But, there are things that happen in the market that sometimes are a prelude to what you may see, right? We talked about whenever you see the dollar, an aggressive move in the dollar like we have, right? Which leads to a tighter financial conditions and that sort of thing. When that dollar rip is done, what usually follows is some type of growth scare, right? Because the tightening of financial conditions, right? The economy gets tighter because of that. And I think that's what we're seeing now. And what, interestingly enough, the dollar's starting to sell now, right? So you're seeing the adverse of that dollar rip, which ultimately could be a good thing when this is all said and done. And we'll talk about that because it goes back to the point that we've been talking about a lot on this webinar. I really don't think we have had a true bull market in equities at all, right? It's been a bull market in AI, a bull market in quality mega cap growth names, but certainly not a bull market across the board in equities. And what we may see once what we're dealing with now play out, is done playing out, at the least, maybe possibly a completely different theme that ends up taking a leadership role. It could still have AI involvement, but just a lot different names involved, right? And you can see some, like, again, maybe it's just the perma bull in me, but the start of a true bull trend. And I know that goes against what everybody out there believes, right? Everybody believes that once the momentum we were seeing runs out, we're going to go into some notorious bear market, right? That's kind of the consensus. But, as cautious as I've been of late, I'm not bashful to admit I do lean to the perma bull side. It's paid off for me in equities. And I think the cleansing that we're seeing now can possibly set off a true bull market and a sweet spot entry on the equity side. Now, again, we probably have to avoid some calamity that some of the stuff we're seeing may cause. But, a lot of times these growth scares, they're just that. They end up growth scares, right? They never materialize into something bigger. Not to say it can't now, but the odds are it usually ends up just being a growth scare and an unbelievable entry into what is more than likely a really nice bull run. Okay, so that's that's my glass half full here, as cautious as I've been now that this is underway. And I think that's a good segue again, just to reiterate what I'm looking for out of this, right? I explained to you guys that one or two things need to happen for me to get excited as far as position building and equities again. One would be we get that legit correction, legit cleansing, right? And I think obviously it's underway right now, right? It's already in process. Either we get that where we wipe out a lot of that long exposure that we've been seeing build up, and I think that has posed to be a problem on a day-to-day basis. We're seeing it right in front of us. Or, I don't have to wait till we get to that point, meaning all the positioning stuff, all the signals on the positioning side we look at, every day in the steam room and every week on these webinars, they don't have to get max short for me to get excited. If aggressive buying on the sweeper end shows up in anything new, right? Any new pockets, obviously that will be my cue. All right, so one of those two things, as I've been saying, it's not new, but one of those two things have to occur for me to simply be interested in putting on any weight on the swing side, swinging positions, right? And the reasoning behind it is that if we're not seeing new buying, again, some of you STEAMROOM members are probably like, oh, here we go again, but it's worth reiterating. I mean, that's kind of why it's gotten me to the point where I am now at my career, right? Is beating my head with some of these things, beating myself over the head with some of these things through the years. But a lack of new risk appetite in fresh names, in fresh setups, has been one of the best signals in itself out of flow. In where a lot of people, especially some of the new people, the newer crowd who follow flow, just ignore, right? So there's reasoning behind what I'm waiting on here, in a sense. But aside from that, I think right now where we're at, we're not quite there yet, but there's been some damage, right? Especially shorter term time frames. So, I mean, let's start there, right? Coming into yesterday, which we spoke about, you had on the internal and breadth. Let's talk about the internals of the market, the damage done, especially on a shorter term basis. You had enough there coming into yesterday for a squeeze setup, right? Again, on a short term basis. So once you start to see that, you look towards some of the shorter term sentiment signals, right? Because again, we're talking short term time frame here. And again, going into yesterday, it was a nice setup, right? You guys have seen this indicator we look at every week. We look at it every day, obviously, in the room. Under 10 is usually a pretty nice risk reward entry for that squeeze. Okay? So the reason I'm saying into yesterday, because yesterday we got kind of that rally, and today we saw some selling, but we're starting from higher levels. So we're probably going to be in that position again going into tomorrow. Okay? On the breadth and internal side, let me give you guys an idea, because this is a pretty good. All right? So this is for Sentiment Trader, measures kind of everything in regards to internals. All right? And when this board is lit up green, right, especially across all time frames, when you have that and positioning on your side, that's what sets a decent risk reward entry to play for that kind of snapback move. The more breadth and internals, I should say, the further out in time frame some of these internals are flashing green, the stronger the signal for a multi-day, multi-week kind of move. Right? Makes sense, because if shorter term breadth and internals are just washed out, just a shorter term time frame, a rally like yesterday can wash all that away. But when you have some of the intermediate term and longer term internals that are washed out as well, it's going to take a lot more than just a one-day rally to unwind that, right? So that's kind of the logic behind it. So this is where we stand going into today. All right, so not really a whole lot to get excited about yet, but today, with the sell-off today, there should be a lot more green on here. Okay, so going into tomorrow, I think you have a better setup for a squeeze on a short-term basis. Now, for me, I would just continue to play for squeezes like we saw yesterday, and when that shows up, I would be more inclined to take that until we get some of that bigger picture positioning more favorable, right? Or again, aggressive new buying show up in the flow, kind of what I'm waiting on, right? So you look to trade these tactical squeezes on a shorter term basis. And the one you want to give some weight and legs to is kind of when you have some of the catalyst signals that I mentioned earlier. Okay, so that's kind of how I'm looking at things right now on a short term and intermediate term basis. I'll give an example to some of you who are possibly not STEAMROOM members, like what kind of positioning stuff I'm looking for. What should I hit up here? Oh, you know what I could hit up? Hold on. Oh, that was a good one too. I could have showed. Right. So see this chart kind of on the right here. This is from Nomura. This is their CTA positioning, equity positioning model. Here's the net exposure on the right. So you kind of want to see this down here, right? And right now, while this is all going on, there's volatility and there's price action and, people banging their heads all over the place, trying to make some difficult money in a crazy market that's the momentum is dictated off what Trump is tweeting or saying at a press conference. The CTA flows, the systematic flows, have all leaned to the sell side. In an up, down, sideways, crooked market, these systematic funds are sellers, right? So that is all happening right now as we speak, till eventually they become a lot lighter on the exposure side, possibly and probably even net short. And then when that momentum turns, that's when the fun and the magic could happen. Right? So it's happening. I mean, it's going to take, obviously, it doesn't happen overnight, especially when you've had such a crowded bullish trade go on for so long without any cracks. But right, like here's the 2023. I think this is the 2023 pullback right here. Right, what we were looking at the last few weeks, talking about that was kind of the only real correction we've seen in the last few years, and this is where they got down to. Right, this was the 2022 lows, the summer, and then ultimately the September, whatever they were, September, October lows in 2022 of the bear market. All right, short. So when you get that cleansing, and think about that, right? No matter how much they have an impact on the price action, I feel like they have a lot larger impact. I maybe don't have the facts to back it up. But again, I believe they have a significant impact on the market. Some people think less so, but they have somewhat of an impact, these systematic funds, and the front running of these systematic funds. When they're in the position they were in coming into this pullback, and they do nothing but sell in an up, down, or crooked tape, that supply that is hitting the market, that's going to make finding any upside momentum difficult. No matter what level you're looking at, no matter what balance sheets you may be looking at, no matter what earnings you may be handicapping, right? It all comes down to the basics of the market, buyers and sellers. And when you have a crowd like this that's been extremely long, and now they've become sellers, to go alongside retail, who was aggressively long and has become sellers, right? When you get all that into momentum shifting, you get the type of market we're looking at right now. Okay? So this is, again, just giving you guys an example. These are some of the things that I'm waiting on, right? And what I mentioned earlier, if you were going to take that approach but still want to kind of capitalize or try to take advantage of some of the squeezes like we saw yesterday, you would size down, again, according to each and every individual out there, depending on how aggressive they want to be. But more importantly, I think you want to be a lot quicker on the sell side, right? Because you're not there yet. Because then once you get that down here, when you get a lot of these positionings to the other side of the boat, Now, what happens down here, guys, is the total opposite of what's happening up here. Okay? They're sellers in up, down, or sideways tape, right? In price action. Okay? Down here, they become buyers in up, down, or sideways price action, right? So now, instead of that supply, you got a bid in the market that you didn't have. Okay? So until we get to that point or close to that point, I think it's probably prudent to clip rallies. Now, the other thing too, because I don't want to put too many disclaimers, but those of you in the steam room, if we're seeing some really healthy buying, let's say tomorrow the job number comes out, the market sells off, right? We're lower or we're flat off the job number, and going into tomorrow we have short-term and tactical sentiment on our side. We got some decent short-term breadth, possibly even more than that on our side. If we see some buying come into a turnaround that takes place, right? Some aggressive sweeper activity, right? Some good-looking sweeper activity that would actually stick out like a sore thumb right now in the flow we're seeing. Then okay, you want to make the point that you want to leave a larger runner, or you want to give a longer leash to a possible squeeze play. Yeah, I get it. But unless you see that, I just don't think it's worth it. I just don't think it's worth it. Right? Not because it can't happen, right? Not because that squeeze can't have some legs, especially as, sold off as we are now, but the difficulty in trying to catch it, right? And the probability of it when you don't have certain things lined up with it, it just becomes a lot harder. It just becomes a lot harder. Right? And another point I want to make too, just to keep people's heads up. Okay, when retail and everybody's chasing zero revenue names that we were talking about after 400% moves, okay, as bullish as you may feel, that's not the place to feel good about things. Right? We talk about that all the time, and we've talked about it for the last couple of months. So I'm not reiterating that point. That point, you guys should. I've hit you over the head enough about. The point I'm making here now is, now that we've seen some cracks out there, right? And as the noise gets even more bearish, okay, that's when you should start paying more attention and becoming more interested in getting long. And I know it goes against the grain of what a lot of us, how we're wired, but it's the truth, because even once you get enough selling done and a lot of these overcrowded longs have been unwound, even if there's more selling to come, right? The odds are when a turn shows up, it's going to be rewarding. Unlike when you're buying nuclear names with zero revenue into the highs off a parabolic move, when the selling comes, there's a lot of selling to come. All right. So I think that's what we have to look forward to. Even if we go into a treacherous bear market, right? At some point, we're going to reach a stage where there's going to be a sweet spot entry and a multi-week, if not multi-month move, even if we're in the start of a bear market. Even if we're in the start of a bear market. And there'll likely be sectors and subsectors that resemble being in a bull market, even if we're in a bear market. Okay, so that's what we have to look forward to. It's just a better spot of entry, period, once we get through this. The problem was getting to this point. All right, let's look at some of the other things quickly that we pay attention to, some of the big picture signals. We talked about kind of this divergence we were seeing before the market rolled over here between some of the credit signals we follow. In other words, the credit markets weren't confirming risk-on bull market behavior. even though the indexes were making new highs, even though retail and speculative names were doing cartwheels, the credit markets were telling us, it's it's not a risk-on climate, and you shouldn't treat it as such. If you do, you're likely going to get burnt. Okay, so that kind of was the takeaway from some of these credit signals. Now equities have caught up to those credit signals, right? So what do I mean by that? You kind of had this divergence as equity markets were making new highs. This was kind of chopping around, not confirming it, right? Rolled over. Now equity markets have rolled over, and you can see a stronger correlation, right? They're back to that correlation. Now, there are a lot of folks out there, and if you remember, I was telling you, a lot of guys that I traded with on the professional side were concerned about things like this because they took it as a signal of complacency out there, right? That spreads were too tight, and that if we start to see the negative part of Trump that people forgot existed, right? Everybody thought just Trump was going to be great to everything. People forgot kind of the negative trait to Trump, that if that showed up, spreads would widen out, swaps would widen out. Not even in an apocalyptic way, just, again, pricing in more risk in the credit markets. And if that's the case, equity markets are going to be risk off as well. Okay, so there are some folks that think that there's still some widening out of spreads to come and swaps to come because of what we're seeing out there. And that ultimately, is not going to be bullish for stocks while that's happening. Okay, but right now you got really no major takeaway here, no divergence, nothing signaling much of anything different, right? And again, a risk-on type of behavior would be exactly this, right? This is shot out of a cannon. These are inverted, so you can see the correlation, of course, right? Right before the election, these things aggressively tightened, and as the market was chopping around before the election, this kind of hinted towards a risk-on climate coming out of the election. All right. So again, just give me an idea of what we're looking at here. And these are credit default swaps, or big picture. Those were IG spreads, credit spreads we were looking at. But you can see the correlation here, right? It's pretty obvious. So if swaps do this, right? If swaps widen out because they're going to price in more risk in the credit markets for whatever reason, because economic numbers are slowing down, GDP is slowing down, bankruptcies are going higher, defaults are going, right? All those things. You would see credit default swaps widen out. That would mean this chart go lower. And again, you see the correlation to equities. So it doesn't take a rocket scientist to figure out that if swaps widen out from here, equities are going to face a headwind. Okay, and what you see why I feel it's important to at least acknowledge some of these things, right? Because in all likelihood, if swaps do widen out, and God forbid in any aggressive way, I don't care what you're looking at. I don't care what else you're looking at. It doesn't matter. It doesn't matter. You can tell me Fibonacci's, Liberace's. You can tell me whatever it is, you have some conviction in why the market is going to be bid or trade higher, right? If spreads and swaps widen out in any aggressive way, the market is going lower. Equities are trading lower. Let's look at some positioning stuff, and then we'll go to some of the more fun stuff. This is what I like about corrections, the fun stuff. We'll get to that in a second. Let's look at, here's what every bull we talked about is hanging their hat on. This is the survey sentiment of mom and pop investors, and they are skittish. Let me tell you, the more I run into people, I could see the skittishness. I see it, right? You see some of these casual market participants who have benefited off the stock market the last few years, like Armageddon's here. You see the stock market? You think Trump is crashing this market on purpose? They already think a crash has happened. Right? They already feel like, and you can see it in some of these numbers. Now, what I will say is that a lot of these surveys, they're just that, they're surveys. Okay? So if you're surveying somebody who has a liberal bias and hates Trump, they think we're in an all-out apocalypse. Literally. Okay? Literally. If you survey Democrat voters or liberals, you would think that the streets were on fire right now. And obviously, if you surveyed the right, that lean more conservative, they don't feel anything remotely close to that. They think what we're seeing is actually constructive. So that's why these surveys, again, I wouldn't say take them with a grain of salt. I look at them, they're useful, but you got to kind of put it up against and with other things, right? Like, to me, positioning takes a precedent over surveys because that's people putting their money where their mouth is, right? You can survey me. I can tell you, oh yeah, I'm bullish as all hell, and not have a dollar invested, right? So that's kind of where you can get some of these mixed signals from time to time. Okay, but this is what bulls have been hanging their hat on for a couple of weeks now. Now you look at like the one that measures kind of the advisors, the pros. That's this NAAIM, and you're seeing a different tune. This week you sort of come in a little bit, but you didn't really see much movement prior to that. All right, those are some of your more run-of-the-mill surveys and stuff. One thing we look at closely, hedge fund exposure. And if you remember, we're talking about a possible issue of, more volatility, at the least in the markets. Hedge funds who didn't really get long the majority of time in this bull run decided to cover shorts, and then eventually, by the first dip, the market gave, as you can see here. Okay? The good news is they already spit that up, right? So they're not long anymore. But ultimately, what happens from here, is going to be a pretty decent tell and signal. If you get them aggressively shorting into what's additional chop or maybe more downside, and you get them to another position down here, right? That would be a constructive, a bullish thing. Again, good depending on what side you're on. Okay, so right now they're back to the zero line. Not much cooking. All right, that's what else? We looked at spreads. Sharpies. Sharpies, interesting. Look at this, right? Let me show this. Now, Sharpies are commercial hedgers. We refer to these, just in case you're wondering what the hell I'm talking about. They haven't done a whole lot in equities. Okay, on the equity side, they've been hedged and they remain hedged. I'll show you guys that in a second. But what's interesting is, even though they're not adding hedges, what they have been adding has been VIX exposure. And the reason why, more than likely, is because hedge funds have been shorting VIX futures. And they usually take the other side, right? So you can see this little lift here after selling the last big VIX pop we had, right? You can see they're always long VIX futures from time to time, net, right? You can see here, they're rarely short They always have some exposure. Again, they're called commercial hedges for a reason, so they're more inclined to be long VIX than short of VIX, right? But when they're short VIX, it's usually a good signal, right? And if they're buying VIX, and I wouldn't say it as a strong signal, but it's always interesting if they're buying VIX, right? So what they've been doing through the kind of the VIX chop we've been in up until recently, they've done some buying there. Okay, nothing too dramatic, but they've done some buying. On the equity side, they pretty much are very little change from where they've been. Where's the updated one here? This? Yeah, this has got to be it. Okay, here's the zero line. All right. So kind of here's where they got a little aggressive shorting right here into these highs. Okay. But since then, right, they've covered that up, that aggressive ad. But they still remain hedged. Somebody pointed out to me they still remain hedged, but as hedged as they were going into the 2022 bear market, they're right about that statement, you know. But I kind of look for these aggressive moves. Right? That's kind of what gets my attention, you know, when they start to get aggressive on the short or long side. And that was here into these highs. And then since then, they've been kind of quiet, just sitting hedged. The bullish signal from Sharpies, obviously, is when they pull one of these bad boys. Bink. And what they do from that point as well. All right, so that's Sharpies. Very quickly, let me run through some of these other things because this is some of the fun stuff. I got a couple of them on here. Oh, I thought I had more. I must have posted them in the STEAMROOM. Here are some major sectors I like to look at this. All right, so when you get these pullbacks, the more wiped out, right, the less selling that's still to come. That's kind of how to look at it. Especially in corrections, when you get a spike up into this neck of the woods in just a correction, those end up unbelievable entries, right? You could see here, here you had a spike just short. Here, this was the COVID crash, so kind of a little different look there. But this is the 2022 bear market. Here. Here is 2023 correction. Here, right? And so right now we're right here, coming into today. Flight to liquidity. When things start to get wonky out there, what you see is to the most liquid instruments out there, the most liquid ETFs. So what you see is in a correction, you start to see that show up in indicators like this. And a lot of times when that happens, you're getting close to a low. Right? So it's starting. You can see there, right? It has started. So the takeaway from this indicator is like when people are giving up on doing stock picking, right? They're trying to find the next golden nugget out there in names. They want to go into the most liquid ETFs for safety purposes. All right, so it's a measure of fear and panic. And you can see the COVID, one of the big outliers here. That's it. I thought I had I must have posted them in the STEAMROOM. I thought I had a few others like that, but I think that's all I have here. I don't want to start navigating all over the place. Here's another one I like to look at. This is the Ridex funds. Some of you may be aware of it. The Nova or Ursa funds. Nova bullish funds, Ursa the bearish funds. and they got impeccable timing. Usually when they rotate aggressively into the bullish funds, usually there's a high closer sooner than later. When they rotate into the bearish funds to take advantage of the bearish price action, usually marks a low. So you can see they chiseled some of that bullish exposure down to a more neutral state, but they haven't really taken the dive to try to capitalize on bearish price action. All right. Again, a lot of you may look at this as, oh man, this can get confusing. It has been confusing in the market we've been in for the past year and a half because we haven't had any pullbacks or corrections, and the buying has been so concentrated, right? It has been secluded to certain pockets and names. And it's been more of a rotating bull market and a rotating correction in a sense. When you remember some of those correlation charts we looked at recently, like those correlation indicators are all at lows. Okay, that's one of the things, the biggest things out there that have been rubbing me the wrong way, and becoming cautious is because when they get extremely low, they have the potential when that starts to turn and they start to creep higher. In other words, when things become more correlated to the indexes in a pullback, you got a lot of room there, a lot of pain to the downside. Right? So again, example, maybe this will make more sense for those of you who don't know what it is. We've been dealing with a lot of dispersion out there. You can buy a stock, the index goes higher, that stock can get killed, right? You can buy it, you can short a stock, the market goes down, that stock rips in your face. Right? So you had things marching to the beat of their own drum out there within sectors. Right? Some semis up, some semis down. Some Mag 7 up, some Mag 7 getting killed. Okay? That's usually the latter stage before you get a cleansing. That usually doesn't last too long. So that's what that correlation chart signals. And then when you get a pullback, right, as you go into a legit correction, and you guys remember this from prior corrections, everything is so correlated to the indexes, right? No matter how great a stock may look to you, if the market goes down this week, that stock is going down with it. All right? So that's when those correlation indicators start to elevate aggressively. The beauty of that is when they top, when that correlation is done with and they start to roll over, those are the best entries you could ask for on the long side. All right? And I make the point, you go from a market where you're looking for sweeper activity in that one name that can go higher, right? In other words, those low probability trades we've been looking for. You can catch the direction of the market, you can have everything right, and you still lose money. We go from that time to where the opposite is, what I'm telling you, that sweet spot where you can throw a dart at any sweeper activity you see for the first couple of weeks, and you're likely going to make money. All right, so complete two ends of the spectrum. Let me see. Do I have one on here? A correlation chart? I posted it on Twitter as well. Oh. Here it is. So this is for tech only. This is tech. So this is a correlation component indicator for tech. All right. So here's where I posted this chart. Okay. Here's where we were before a little pullback there. Right. So, when you're staring stuff like that in the face, you don't feel good about putting on weight on the long side. And you hear a lot of people refer to it as a stock picker's market. And I think that's the worst thing to tell people because they think that they got a high probability of picking a winner if they're good stock pickers, where it's a lot more difficult to pick winners. As a stock picker, in my opinion. But the opposite of that, right, is when you get these things, when this indicator elevates. Again, this is just tech, so it's not you're not seeing it as clean. But to give you an example, here's the bear market elevation, right? Topped out, rolled over, and that's the sweet spot I'm talking about. COVID, topped out, rolled over, right? All these pullbacks, very similar. Oh, here's another one, S&P 500. Here's a better one. 3-month realized correlation. Here's 2023. That doesn't look right though. I don't know. But anyway, you can see the ups and downs here too. Does this show it a little better? Yeah, a little bit. Again, that's just tech. All right. Let me see. Do I have anything else here? And again, I don't want to get too wonky other than that, but there are you're likely going to hear more bad news. Let me leave it at that. Economically and stuff like that. There's probably more negative economic surprises and stuff like that to come because of this, in my opinion, this tightening that we experienced. And now you got the fear of tariffs and stuff. So the economic prices, the economic news probably gets worse before it gets better. But depending on positioning, that doesn't mean it gets worse for us, looking for opportunities. All right? Again, if we wash out we're kind of hoping for, that's when you don't concern yourself with all that negative news. Right? Because the bulk of the selling's already done. Again, at the 2022 lows, as difficult as it was, and I know for me, looking at these things for 30 years, and I still couldn't get super aggressive on the long side off the 2022 lows because of what the Fed was doing, right? They were purposely tightening liquidity because of inflation. So it was kind of like a rigged game, right? But even with that, okay, the bear market of 2022 lows, there was nobody long anymore. Everybody was short. Everybody was short. Everybody has sold. Nobody wanted to be long. A recession was guaranteed to us. Guaranteed. The Fed had to keep doing what they were doing. This time it's different. Remember those words? Because of inflation. But because of positioning and where it was at, in all likelihood, even if the market couldn't go higher because the Fed was rigging the game, and this is the argument we were making, it was going to find a lot more difficult of a time going lower than going higher because of positioning. Over here, right? Because at this point, even, there was nobody long anymore. Nobody. Coming out of, remember, SPAC bubble land and meme bubble land and everything else, at this point here, nobody was long equities and risk assets anymore. Nobody. All right, my friends. Here's another one. I found one. So this kind of measures, it's called a cycle panic indicator. Right? So this measures panic. And we have a little movement. All right. So again, just it's one thing if you're at the start of a bull move and you're waiting for this. You could be waiting a long time and miss a lot of opportunities. The point we've been trying to make on this webinar for the last, at least maybe month or two, is that you're at a point where something like this, there was a higher probability of something like this showing up than not. At some point, it was just a matter of, is it going to happen really soon, or are you going to wait a little longer than you would like? Okay? But again, the beauty is not that, all right? Even though I like not losing money as much as I like making money, okay? Sometimes it's more important. A lot of times it's more important, to tell you the truth. But the beauty of it is that when this starts to material, when this starts to get underway, and you get something like this, you can see what happens. Right? It's no coincidence. Look at the entries. Right? Like, just look at the entries. Now, granted, if you go into 2008 debacle, okay, there is a possibility that a spike here only results in a squeeze for a couple of weeks, couple of months, if you're going into a treacherous bear market or a bear market, let's say. Okay? But if it's just a correction, something we haven't had in this market since 2023, look at them. Here's 2011 correction. Oh no, 2010 correction, 2011 correction, 2012, or it might be 2013, 2015, 2016 correction, bink, bink. Early 2018 correction, bink. Late 2018 drawdown, bink. COVID, bink. Here's the start of a bear market. Okay, so the first spike here only resulted in a squeeze, right? In a bear market. But the others, lows. And here's the 2023 correction. Bink. Right? So again, when you start seeing some of those warning signals show up, and one of them that I think we don't talk about enough is a lack of new buying in fresh names. When you see that start to show up and you're here instead of here, you have to be really, really careful because you can get effed up really hard. Okay? So now we're on our way up. We're on our way up now. All right. I think I covered what I wanted to cover anyhow. All right. So just to put a bow on it, because I see T, you came in a little late. You forgot about me. I won't be personal. But what's likely going into tomorrow, we're likely going to have a similar setup that we had going into yesterday. Right? Where we want to lean bullish tactically. Okay? Especially if there's more weakness. All right? We'll confirm that tonight, STEAMROOM members, when we get the updates, obviously. But it looks that way, right? Off today's action. So if we do get any more selling, especially tomorrow, we want to lean bullish. And I think more importantly, if you play for a squeeze, right, you still want to treat it tactically. You still want to be quicker to take profits, unless the flow tomorrow convinces us otherwise, right? If we start seeing bombs going off, like you saw the action today, right? Like here's the action today. Oh, I'm going the wrong way. So that's not the action today. Did I post the? Oh no, my bad. So here's the only that caught nice action today. Okay, and it's a repeat name. We've seen a ton. I get it. Okay, but my point being is, if we see stuff like this show up into a bounce, then you want to give a longer leash to a squeeze. That's a good idea. I think it's worth it. It's worth it if you want, if you looking for a bigger move. But if we don't see, and we see the action we're seeing as we've been seeing for a long time now, since even before earnings season, you probably want to quit. You want to clip it if you get a nice move, right? Because ultimately, the way we should look at it, and we were talking about this in the steam room, you're kind of looking to grind it out now, right? If you can make some money, that's great. Ultimately, being patient for that better setup, right? That's what we're looking to do. And again, that better setup is either going to result from positioning being completely washed out, or I should say, or sweepers getting aggressive on the buy side for the first time in a couple months. Okay, but I'm telling you from experience, the more difficult part, and I'm telling you, for me, I'm the guy preaching to you, and even for me, it's still so difficult, is that when that scenario is close, not even when we're there, when that sweet spot scenario is getting ready, you're probably going to feel the worst. Just like you probably felt the best when you shouldn't have been 2 months ago. Make sense? You're going to hear tariff this, AI bubble pop this. You're going to hear economic disaster. You're going to, more than likely, it's not going to be any good news or anything you're going to have conviction about. Okay? Almost always that's the case. And a lot of times, the better the sweet spot, the sweeter the sweet spot, the worse you're going to feel. Here, you couldn't see a scenario where there wasn't going to be a pretty vicious recession. It was just, how bad can it possibly be? It's either going to be bad or a debacle. No one could envision anything other than that. You fed the most aggressive tightening cycle we've ever seen from the Fed. Right? It's always like that. Always. And the opposite is when they're buying zero revenue story stocks up already 5,000%. Trump later. Yeah, there are people there saying that, Trump and the team they're purposely, this is being done on purpose. And you know what? If it is, I get it. I totally get it. Now, you're playing with fire. because it's not like you're driving in a remote control car here. You know, you can't control, and that's, I think, maybe Trump's problem. He thinks he can control everything. But, a lot of people are making the point that they're purposely trying to slow things down because you got to listen. And I'm not trying to make a political statement here, okay? But there was a lot of shit being masked coming into Trump's presidency, right? You had a lot of stuff that was brewing. And I think the only way to kind of curb some of these prices getting out of control, like, listen, you can have the stock market go parabolic, but if asset prices of goods are going parabolic with it, what good is it? What good is it? You know what I mean? So I think they needed to cool things off. They need things to cool off. They need a growth scare. They don't want a recession, but they need a growth scare, right? For interest rate policy, for everything. For everything. So, I could totally understand what they want here, or what they may be trying to do. And if they get it right, there'll be some agony and pain early on, but then, like, think if they get it right, you cool off, let's say, some of these inflationary pressures, maybe, God forbid, even get some deflation into the picture. You get interest rates and the Fed back on your side again, and you flush out some of these bubble pockets out there that are emerging. So there's a lot of good on the other side of that. There's a lot of good on the other side of that. I think the risk becomes that, let's say you're trying to do that, but you have some dangerous things out there right now. And I'm just talking about, like, even the equity market. You got a lot of levered shit out there that once that unwinding process starts, you don't know what that looks like. You don't know how bad it gets. No one can predict what the unwind of crowded, levered assets look like. It can get really, really ugly. Too ugly. And I think that's why I think the positioning stuff is so important. And to me, it's worth, even if we were going to get more of the same, right? Even if we were going to get a market that's choppy but up, no participation, a lot of dispersion, and it's not worth the risk of getting caught in an unwind of that, because it's only going to make it worse. It only makes it worse. It doesn't get better on its own. So we've seen some of, right, some of the impacts, some of the ramifications from these crowded spots, but it hasn't been completely unwound at all yet. And, sometimes you reach a point where when things unwind to a certain degree and you get some margin and all that shit comes into account, that's when it gets really, really ugly. So the only time you can feel really, really good, right, about putting on risk again that you want to hold is when it gets unwound. Right? Not a quarter of a way unwound, not halfway unwound. So that's kind of where we're at, my brothers and sisters. All right? And again, more for STEAMROOM members. I'll probably lose some of you folks who aren't. There are things to pay attention to if you're trading intraday. Not to say it's easy. This market's nuts. But when we have a sentiment and some of those signals on our side, short-term stuff, spreads have been a nice cue, right? So if you're seeing a rally and the credit signals we pay attention to are confirming the move, right? And you're coming in to that session with sentiment and internals on your side, right? You can stay a little more loose there, right? You want to stay more involved there. To where the opposite, if you're not seeing credit, confirm it, be quicker to get out of it type of thing, right? And volatility too, right? VIX and VVIX remain bid pretty much all day today. You got the job numbers tomorrow. That could be the reason why. But, tomorrow, if we happen to see a turn and an unwind of that stuff with credit confirming it, with sentiment on our side, could be a nice squeeze. Could be a nice squeeze. Otherwise, it's tough, guys. You know what I mean? It's tough. Playing both sides is tough. You're gonna make money. You're gonna lose money. Hope you don't get hit over the head and come out with some profits. But it's tough. It's tough. So this was the top action today. VRT. I was talking about it and I kind of lost track. All right. Did I put the call spread on here too? Yeah. So you had a July 110, 140 call spread, 15,000 times, bigly. And then you had a few nice June sweeps. Okay. VRT has been a huge winner. Name went parabolic. It's a great stop. All right. It's just you got a correction there and somebody's coming in. Thinking there's enough damage done for at least a pretty healthy bounce. All right, but that was the only action that impressed me today. We've been seeing a lot of this isolated, like respectable, but isolated orders, right? So, Snow caught a bounce bet, April 180s. Just playing probably a bounce off today's weakness. Boeing caught a little bounce action, April's. Bank of America has seen this from time to time, some bounce action. CLS, that's another one of those good names that had a pretty healthy run. All right, so again, possibly just playing an oversold bounce here. This name too, a lot of good-looking flow in this name for a couple years now. And you had call spreads. Corning, March call spreads. I think they got an investor day coming up. And WDC April call spreads. This ALGM is a semiconductor. They turned down a bid from ON yesterday. ON semi. ALGM. So they turned down a takeover offer from ON. Today they were buying March 30s. All right. But again, these are just, in my opinion, they're just bounce bets. All right. You can see the difference. This and this. There's an appetite here. The other ones, they're taking stabs. They're taking stabs. What's the saying? You're gonna make us buy to jinx us. Let it play out, will you please? We've come this far. I mean, the 200-day looked like you needed a miracle, no? A couple of weeks ago. LT, what are you talking about over there? You talking to me, or you're just talking stocks? Avgo all off earnings. Yeah, I mean, yeah, these are the names that they just quality, but they're crowded. You got to be careful with these things. But again, they haven't really. You have a little crackage, but this is not. Anybody who's in Avgo, right, is not selling Avgo. There's not that damage there. So I think that's the risk. This one too, Costco. Right, like these are some of the biggest winners. Visa. Right, they've been hiding out in these things. Spotify. Like, look at this. So these are usually the last to go. Usually the last. And they don't, when I say go, they don't have to crash and burn. They're not hims and hers, they're quality names. So you don't get that rush to the exits unless there's a calamity out there, but you can get this menagerie, right? So that's what I mean. They don't, Visa, Costco, they're not, there's nothing wrong with these companies. They're being used as hideouts now, right? So when that gets to an extreme, the market doesn't reward hideouts, especially in a risk-off environment. Trump is saying it's a globalist conspiracy, right? The stock market weakness. It's the globalist. It's the deep state. What else you guys talking? Yeah, Tesla. I mean, complete washout there. You would think you get a bounce at some point here. Oh. I mean, you would think you get, I know it bounces periodically, but a bigger bounce than that. I mean, this is a straight out piss. Completely wiped out this blow off, right? Just completely wiped it out. And now it's right back in the middle. Like, longer term, if you bought Costco in the 2021 bull market, you're down on it, right? If you bought the lows of the bear market, you're up a little, Like there's ridiculous moves in between, but so like even this move in Avgo, it doesn't really tell me anything. It just could be middle of what could be chopped for the next 9 months, for all I know. Again, Microsoft was. It's funny. I got trolled on these webinars with Microsoft, and even the semis. I got trolled by people trading the market for a good year and a half. Well, Microsoft is the king of AI. Unless the AI bubble pops, there's no way Microsoft is dead money. No way. Oh, well. Okay there, Riff Raff. Whatever you say. Do you see their numbers? Do you see the growth in data centers? You're clueless. Down. Yeah, but those are rolls, Sahil. You're gonna start complaining about rolls. You're down money. I don't want to hear you complain about rolls after you pocketed a pile. This guy, he's crying with a loaf of bread under each arm. I might be down on my third roll. Get down out of here. You know what I'm saying, T, right? You know what I'm talking about. What else? Oh, T, that name that you like, I think you like the name. You've been liking the name. Had unbelievable numbers, this thing. They didn't care? I guess just the market, huh? Didn't they have great numbers, this CRDO? But yeah, again, I don't think it matters, right? Like the company, it could be fine. It's just you had air underneath it, and it's just the market. 2027 rolls. Sahil's complaining. I don't want to hear his mouth. I don't want to hear you complain, Sahil. I did, but it's a killed data center trade. Yeah. I mean, all these names, they're good. They're good companies. They're great growth companies. It's just they're all in correction now. They're all in correction now, but there'll be opportunities. You gotta let this play out, and there'll be opportunities. If not the old ones, you'll find new ones you like. It's just tough now. It's difficult. It's too difficult. It's too difficult. You think Tesla goes back to highs? I mean, when? Like when? Papu? Like, will Tesla ever go back to highs ever again? What? That's not far fetched. You know what I mean? That's not far fetched. The question is when. I don't know. I have no idea. If, again, example, if this is just a growth scare, ends up being a cleansing, and then it's a sets off a bull market, right? A whole new bull trend. Yeah. I mean, it would be expected. It would be expected. But you don't know. I think, like, listen, all I could say is, right, if you're talking about longer term in the name, okay, you're better off them after they pull back, look like shit, and go dead. Okay, as a longer term play, because even if you're early on it and it's out of favor and you lose money over the short term, okay, this happened already. Okay, the point I make with these names is if you're buying up here for new risk here, okay, even if it goes higher short term and you're not selling it, when this shows up, you're getting walloped. You know what I mean? Like that's what a lot of, especially like the traders, they don't realize, right? You may be up on it for a few weeks, but if you're not looking to sell that rip, right, you're buying for longer term, that is not an ideal entry. Let's say, for example, the opposite. Okay, let's say Tesla here, right? And you're because you like Tesla, the company, longer term. You understand? Over the short term, you were early, you felt some pain, but over time, that wasn't the worst entry in the world, even though you got it wrong per se. That's the point I make. Like, to me, I always feel better buying after this than after this. Yeah, exactly, Fedora, right? Okay, again, nothing's guaranteed in this game. Tesla, for all we know, Elon Musk could have cooked the books, and Tesla goes to zero, right? And all we're talking about goes out the window. But a lot of these growth names that are legit, you try to buy them when they're out of favor, And here's an example, okay? Again, and I know like this is the most hated stock out there now for good reason, but like an AMD, right? Like common sense, right? Here, up near 200, where everybody was piling in like they cured cancer, right? You're in debacle land now. You're in debacle land. But let's say, like we were talking about recently, you're buying at 115 recently here off this drop. Now it's under 100. You're down on it, okay? You may feel some pain over the next few months, but ultimately, right, you get a bull run in this thing back to 160, 150, and you're in good shape. Like I'd much rather buy an AMD now of this when nobody wants to buy it than up here when everybody's buying it. It's not even a question in my mind. In these well-known names, quote unquote blue chip names, or whatever label you want to put on them. What time? I got to keep an eye. I got time. 6 o'clock. I got to make sure I get out of here. Exactly. Everybody hates AMD now. And listen, I understand why. I get it. But it's the whole. I think AMD was the first to show us what is actually happening in semis as a whole right now. Yeah, it's just been tough. It's just been tough. That DAX chart is insane. By the way, we saw some put buying in EWG today. This thing is nuts. Nuts. They bought, what were they, April or June? April, I think. EWG puts. So somebody either betting on downside or put on some protection there. Look at this move. Let me see. Let me find them quick. German put sweeper right here. April 39 puts. And yeah, they're all Aprils, I think. April 39 puts. So EWG, that's the iShares ETF for Germany. And you talk about hated. This by far was the most hated market on the board in late 2022. The most hated board. Outflows like crazy. You don't remember? I keep mentioning it. You remember the stories we were hearing that people are going to be without electric and heat in Germany in the cold? They're going to have to light fires. What were some of the stories you were hearing coming out of there? Still don't know why this happened. I know the recent move because of that stimulus and all, but prior to that, why is the German so hot? Later, D. Oh, are you talking to me? Oh, I thought you were saying bye. But then this has been nuts, this move. Nuts. Any thoughts on China? Yeah, I mean, again, I'm not a big China guy in general. I like to play U.S. stocks, but I just wouldn't go crazy. But there are a few China names that have seen some interesting action. This one, GDS, China underbelly software AI name. The other one, I forgot the symbol. Just you guys probably remember. What was the other one with the GDS that I like? The AI play. What the hell's the name of that thing? I forgot. There's a spec name. I think they report earnings. I like to see if they buy post earnings. This Tuya. But I have more of an interest. Like, listen, Baba is the pure AI play there. Like, right? That's it. Everyone's going to own Baba for AI. But kind of these are like the finding like these hidden underbelly names. The only problem with some of this stuff is, again, the move they made, right? So now they're just digesting this move. Anybody remember that other China underbelly name that we liked off the flow? Sweeper activity. It got shot out of a cannon. GDS, and it was another, I think, three-letter symbol. It was like it was $6, and I think it went to like 15. Oh, it was such an easy symbol to remember. I get VNet, 4 letters. My bad. Thank you. Thank you, Steven. That would have bothered me all day. VNet, this guy. So off the flow, off the sweeper activity, like these are a couple of underbelly names that have caught my eye off the buying. And these are, again, tech AI. If you're looking for aside from tech and AI, like if you're looking for just China related, they buy a lot of these spec names, like the brokerage firm Tiger, this one, Futu, like these type of names. But I like GDS and VNet if you're looking to play AI there, in a more speculative way. But I'd be careful if you're an equity player. I'd be careful with any of these names buying equity. I really would. I'd be careful. You're better off buying calls. Put in what you're willing to lose, time, and give it a leash. Because if something goes sour with a GDS and you're buying equity at 40, and they take it down to $4. I mean, I've seen people get lit on fire. Luckin Coffee, or just even, I remember like these China online names. I told you guys this. These were considered China blue chip names. Like funds were loading up in these things. And I knew quite a few people who had the equity of these things in their accounts. Look at this. 200 down to 10. No. Yeah. The other one, Tao. Look at this. 90. Look at this little skid. How about that? So I'd be really, really careful buying China. Yeah, I would treat it as gambling, speculation, and I think that's what options are made for. I think it's perfect for calls. Yeah, remember? He exactly. He pulled the plug on the online education names. They were making a ton of money. So if something like that goes wrong, you're dead, and it's dangerous. So be careful. Yeah, you remember him, right, LT? He took a beating after his little corruption he was involved in. But if you put a gun to my head, speculative names like if GDS and the VNet, I like as AI plays. Yeah, but you got to understand, okay? Cheap fundamentally in China terms is a different than cheap in US terms. You understand? You don't know what, like we talk about, they stuck their hand in the Baba cookie jar too, the government. You remember when Jack Ma was missing for like months? They thought he got whacked. They thought they bumped him off. Yeah, you take a shot is fine. Just don't go crazy. Don't go crazy. You know, you want to buy something now to try to buy you some time until U.S. equities find some footing again. You do it that way. Charlie Munger bought Bob After. Yeah, there was. I'm telling you, when you had that China bull market, these names were staples in every fund. Everybody owned. Everybody. Ethan Hunter's Jack Ma. Yeah, she went after him hardcore, right? I don't know what the hell he did, but he did something. So that's well, now let me think quickly. Just U.S. names that are seeing some interest worth sharing. I'm trying to think. Yes, mostly shorter term stuff. IGT, but that's not even. I don't really have anything, guys. I really don't. Yeah, I don't. They bought a shipper the other day. Caught some nice flow. What the hell was the name of it again? Hold on, let me think. Hold on. Seabulk? Was it Seabulk? Yeah, right. I think it was Seabulk. Starbulk. Yeah, I think this saw some June action. I think this was it. This was it. So I had some, respectable June buying. This is a shipper. Home builders, they're trying to catch a bounce in DHI. Bounced a little bit here today. But if I'm not mistaken, I think they actually bought some up here too. But I could be wrong. They definitely bought some here. I'm not sure about here. And I think they were for the end of March, the calls. Yeah, but these things, they've every little pop they've been selling these things. These home builders, every little pop. Maybe they form a bottom here and they start to carve out the right side of this chart. Right? Maybe they bottom before everything else. Definitely possible. But I'm not excited yet, especially off the flow there. I'm trying to think of names. You know what's been the hottest group on the street is the overseas stuff, right? Have you seen some of these things? Look at this. European financials. Look at that chart. Okay? You throw a dart at any European financial, they're going parabolic. Deutsche Bank, good old Deutsche Bank. This stock was a single-digit piece of paper, couldn't get out of its own way for the life of it. Look at this. Okay, ING, these things didn't move. Look at that. They couldn't move for the life of them. Barclays, I looked at Barclays. Let's see. Barclays, yep. So this has been the hottest group on the street. Overseas financials and overseas in general now. We've seen flow like in names like Metal, MT, Some of these ADRs. But guys, if I need to get excited about this stuff, then that right there tells me it's probably just a good time to take it easy. Again, play. We all want to play, but take it easy. Don't hurt our brains or our wallets. It's not worth it. It's not worth it. Because when we're talking about these names catching the flow, that's catching our eye. That means flow is pretty bad, right? That means the action's been pretty bad. EWZ. Let's see. I haven't looked at that. So this thing's hasn't been doing much, right? It's kind of been in consolidation. Wow. I remember when this market was hot and catching a lot of flow. You know what we made? BRZU. Is that the levered one? Yeah, that's it. BRZU. 2-time levered Brazil. 2-time levered Brazil. Lunar. Yeah, that had a mishap today, right? Something went wrong with their moon trip. Lunar. Oh, that's a name that's had some bullish momentum and excitement the last couple of days. ASTS. I don't know why. I know a couple guys I know that like this name as a longer term spec name. I don't know anything about it though. ASTS. How's this one been doing? RKLB. That was one of my favorites flow wise, RKLB. That came in a bit here. Lunar down 30% after hours? No, why? What'd they do? Oh, it was halted, right? It was halted. It was halted. So it opened up 7 and change. Lander did not land upright on the moon. Poor bastard. Yeah, these things. I mean, this is all story in these things because I don't think. Yeah, they don't. They have a little bit of revenue, but there's nothing really cooking in these things. Let me see. Like, are these things expected to make money at some point, or they're just excitement, rockets? What else? Oh, one of the nuclear plays we saw them caught some July buying. ASPI. I think a few of you have traded the name or liked the name. I don't know. But you had a little bit of July buying. But there's nothing new. Nothing new that has really caught my eye. Otherwise, that probably would have been the first thing I told you about on this webinar. But if you're looking to play now, I think for trades, these bound trades are worth looking at. We don't need to see new names if you're just playing a bounce. You just want you kind of want to see the overall market line up, right? So you have a higher probability of catching that bounce. But example I'm making like VRT. If if this is the name you want to, take a stab at to try to catch the market bounce, and you want to play it through a name somehow, it could be VRT off that action. I think Bova is still. I was trying to find a note for STEAMROOM guys today. Bova, I think, is really still bulled up on this VRT. But you're talking about this thing is no slouch. Let's see, but over $2 billion in revenue for the quarter, and they earn $1 a share. You know, this is no piece of garbage. This VRT. It's just this move, right? Talking about a huge. This thing was $10 in mid 2023. It hit 160. What chart is that you posted in the STEAMROOM, Sal? What is that? S&P 500 index weekly. Yeah, what's this? What are these lines here? What's diverging from this? Or is it two separate things? You could type in the STEAMROOM, Sil, if it's easier for you. VST has come in too, right? So he'll a decent amount. VST. Yeah. Oh, SPX versus DAX. Interesting. Wow. Look at that. SPX versus DAX. Look at that. Crazy. Crazy. And guys, here's another chart that kind of tells you what we're seeing in the market right now, flow-wise. SPX lags DAX. I mean, lags, well, this is a little bit more than a lag, no? This is diverging from DAX. I don't see any gap like that anywhere here. This maybe? And then kind of close? Not that extreme though, right? But that's an interesting chart. What was I talking about now? Oh, this. So this kind of gives you a good glimpse of what we're seeing in the action. XLP, XLY. Look at that. So this is staples to discretionary ratio. Right? So when this is going higher, you got more of a defensive market. You got defensive leadership. And when it's lower, you got more of a risk on type market. All right, so look, here's the 2022 bear market. All right, so this was trading obviously higher. You know, lower net since then, especially here before and after the election, and then now you this. All right, so literally the whole month of February been all defensive. I personally liked the staples. You remember we were talking about them on here. I was worried about tariffs. I didn't know how tariffs would play in all this. But you had a nice entry off this pull here in staples. But the other thing is like, what name was I going to buy? What am I going to buy? PG, Colgate, or do I buy the ETF? There's no levered ETF to kind of turn around. Like, there was nothing for me to do. The washed out group, if you're looking to make a play on a washed out group, you got kind of materials that are pretty washed out, positioning wise. The most shorted group has been discretionary. The hedge funds have been shorting discretionary in this the last couple of weeks. All right, guys, I'm gonna bounce here. 6 o'clock. I gotta get out of here anyhow. But yeah, let's see. Again, for STEAMROOM members, we'll see you off the updates tonight. But let's see how the job number shakes out tomorrow. But I think we probably line up. We set up well to lean bullish for a squeeze. All right, so we'll take it from there. Everything else, we got more work to do. All right, so we'll just keep tabs on it, keep an eye on that in the flow, and take it day by day, week by week. But ultimately, there's light at the end of the tunnel, my friends. And remember, it's only money. Have a good night, everybody. I will see you mañana. Have a good day.